Hi, everyone. Welcome to the webinar. We're going to start in just a couple minutes, more like 1 minute. So just let some people get started here. Welcome to you all. So happy that we're here, that you're joining us. It's Thursday evening. I'm Sarah Spagnolo. So happy you decided to join us this evening for this awesome webinar hosted by Stash. Give it just a couple more seconds. Welcome to you all. Welcome, welcome. Make yourself at home, grab a glass of water, grab your popcorn, drink, Coke, whatever you like. Anyway, so happy you're here. I think we'll start. All right. Hi, everyone. I'm so happy to welcome all of you to today's webinar hosted by Stash. I'm Sarah Spagnolo. I'm the managing editor here at Stash, and it's my absolute pleasure to have all of you here. I'm coming to you live from our office in New York City. Thank you again for coming. The webinar today is part of our Quick Start Your Stash program, which is helping people get started on their path to achieving your financial goals in 2024. Without further ado, I'm going to introduce you to our special guest and panelist for the day, Natalie Taylor. Natalie is a certified financial planner and a behavioral financial advisor who's focused on helping people make great decisions with their money and building financial resilience. Let me take down this big slide for a second. She draws on close to 20 years of comprehensive financial planning experience, 10 years in fintech, and a decade of professional speaking to share advice that works in real life, not just on paper. She joins us from Santa Barbara, California, where she lives with her husband and 2 boys. Currently, she spends most of her time running a fast-growing financial planning firm focused on helping mid-career tech professionals with young families and equity compensation. That's why she's here talking to us about how wealthy people make money. She also speaks all over the country on personal finance for both consumer and advisor audiences and serves as a company advisor to Monarch Money. And when she's not doing all of that, you'll find her on the field coaching soccer, flag football, and baseball for her boys. She is a busy professional. As a reminder, this information we share today is purely educational. We're not providing any financial, legal, tax, or investment advice. That's a required disclaimer. Thanks again to all of you for being here. Natalie and I are going to begin this session with a fireside chat, and then we'll take Q&A for about the second half of the 40 minutes that we have together. All right, so how did we come up with this webinar topic? And Natalie, maybe you want to just say hello real quick?
Sure. Hello, I'm Natalie. It's great to be with you. I'm joining you from the West Coast in Santa Barbara.
Wonderful. All right, hi, Natalie. So the question I wanted to start with was, how did we start and come up with this particular webinar topic? So here's the behind the scenes information. We conducted a survey at Stash in the fall about hardworking Americans, and we learned a whole lot, including that money is far and away the top concern for people. And also that nearly all of survey respondents, about 89%, think about how wealthy people make money at some point in time. 95% of millennials and Gen Z think about it. And even more than that, nearly a third of that group of millennials and Gen Z think about this topic all the time. So we wanted to go to the source. We wanted to talk to Natalie and to find out, how do wealthy people make money and what can she tell us about that and what can we learn from it? So Natalie, to start, let's start with a question. Who are, quote, the wealthy?
Yeah, that's a great question. I'm going to share screen real quick and pull up a slide here for us to look at together. The wealthy, I would say, we're defining by millionaires. So somebody who has a net worth of $1 million plus. We hear a lot about billionaires in the news, but here I'm focused on people who have a net worth of $1 million or more. About 1/3 of millionaires inherit their wealth, and about 2/3 are self-made or they earn their wealth. So that 1/3 that inherits wealth, that's not a demographic that I spend a ton of time serving. I'm typically serving those who are first generation self-made millionaires. But of those that do inherit wealth, or for those clients that I've worked with that either may inherit wealth in the future or have inherited wealth, I will just add a little like behind the scenes peek that for many of them, that inherited wealth comes with a lot of strings attached, whether it be emotional or behavioral or expectation related. And that can be really challenging. So for the clients who haven't, there's also often not a lot of clarity around how much will they receive, if anything, and when will it come. And so for planning purposes, we often just assume that it doesn't exist. So although it sounds great to think that you might inherit wealth, we're mostly pretending that it doesn't exist because they don't really feel like they can depend on it, and they feel a little uncomfortable depending on it, or a little uncomfortable with the strings that are attached to receiving it. For the other 2/3 that are self-made, that have earned their own million, if you will, the top 5 careers of millionaires from a few years ago were engineers, accountants, management, attorneys, and teachers. And I have clients who are in all of those professions, although I have fewer teachers because I don't generally specialize in federal or state governmental benefits anymore. And then a more recent list adds a few other professions to the list, including entrepreneurs, tech and AI workers, doctors, pilots, and investment bankers. And of those, I don't have any investment bankers, but I have clients who are in all of those other professions, a lot that are tech and AI workers specifically. What I find really interesting is that only 31% of self-made millionaires averaged 100,000 per year of earnings, and 1/3 of millionaires never ever earned a 6-figure salary. So what that tells us is really interesting. It's that decisions made over time, good financial decisions made over time, is absolutely a path towards becoming a millionaire, and that you don't necessarily need to inherit wealth, nor do you need to make big, a 6-figure plus incomes to be able to become a millionaire.
I think that's so much good insight, and probably really surprising to many of the people listening here with us tonight. Over 700 people here tonight. I'm wondering if you could paint the picture of the types of people that you work with on a day-to-day basis, just to bring them into our mind's eye. You said their occupations, but what is their life like today?
Yeah, good question. So the demographic that I really focus on are those that are self-made. They're usually between the ages of 35 and 45, mostly partnered, some same-sex couples and some opposite-sex couples. Most of them work in tech. Some of them work for public companies like Google or Facebook or Amazon, for example, and some of them work for private companies that haven't yet gone public. So their stock doesn't trade on the New York Stock Exchange or the NASDAQ. On average, their income tends to be in the $700,000 to $1 million a year range, but it fluctuates quite dramatically, which I'll touch on in a minute. Their income might look like a base of $275,000 of a salary, maybe $100,000 in bonus, and then for public company employees, it might be anywhere from $200,000 to $500,000 of restricted stock unit income, which basically means they get paid in stock every quarter. And if the stock is worth more, then the compensation is worth more. And if the stock is worth less, then the compensation is worth less. So there's a ton of variability on that. The bonuses also aren't guaranteed. So you could make $0 on your bonus, or 100,000, or anywhere in the middle. So that's very typical for my clients. And their net worths, although they range from just over $1 million to, I think my largest client has actually a net worth of over 30 million. Most of them have a net worth between 2 and 3 million. And as they're higher earners, their income becomes more variable. So those that make 700,000 to $1 million a year, they don't have a salary of 700,000 or $1 million a year. Their salaries are a much smaller portion of their income. And then their bonus and their equity compensation. So equity compensation meaning that restricted stock that I talked about, where you get paid in shares of stock, or on the private company side, getting paid with stock options, which give you the right to buy your company stock in hopes of selling it for more later. That becomes a much larger portion of their income. And so their income is actually quite unstable. because they don't know how much they're going to make. They're also way more prone to be out of work for longer periods of time, because as they have higher and higher level positions at their companies, a company only has one CEO or one CMO or a few VPs or, several directors. As you go up the chain, there are fewer of those roles. And so they may be in between roles for anywhere from 6 to 18 months is not uncommon between jobs.
So it would seem like just like everybody else, they need to be sure to be cognizant of how they're spending, saving, and investing their money.
Absolutely. Absolutely. And I'll say that burnout is also really common among this specific niche of millionaires that I work with, especially for working women with young kids. I have clients who are in their 30s that are on blood pressure medication who take really good care of themselves, but have really stressful jobs. I had multiple clients out on medical leaves of absence last year. I have several clients that are working with coaches and therapists to help them learn how to manage the high level of stress that they have at work. I have a client whose goal is to try to only work 60 hours a week this year. That's her big goal for personal growth. I don't share those things to say that their lives are easier or harder than anyone else's. I only share just to say that this is what it looks like behind the curtain. So, and above all, I would say that my clients are desperate for getting their time back. They're desperate for freedom over their time. And that's really what a lot of our financial planning is aimed at, is buying them the ability to have more flexibility over their time.
So, I was going to ask you about conspicuous consumption and how we see that everywhere. You talked a little bit about that and what you see when you peek behind the curtain. So I'm wondering, for all of us here who are working so hard every day, is there a way for us to see how close or far away we are from living with a sense of financial freedom? This is something that you specialize in a lot. How can we use the frameworks that you work with and use for your clients in our own day-to-day lives?
Yeah, that's such a great question, because knowing where you stand is so important. I find that for a lot of my clients, it's like, I have X amount of dollars saved. Is that a lot or a little? I don't really know if it's a lot or a little. So one really helpful sort of framework that I would share with you is a multiple of salary saved for retirement by certain ages. So this is from a well-researched study from a few years ago, that by the time you're 30, if you can save an amount towards retirement, and retirement just means having enough that you don't have to work anymore. So that's financial freedom, financial independence. If by the time you're 30, you've saved the equivalent of 1 times your salary, then you're on track to retire in your mid-60s. So let's say your salary is $50,000 a year, or you earn $50,000 a year. That would mean by age 30, your goal would be to have $50,000 saved in your retirement account. If you're not there yet, totally fine. There's plenty of time to catch up. By 40, this framework would say that you should have 3 times your income or your salary saved for retirement. So if your salary is $50,000, then by age 40, you'd be looking to save $150,000 total in your retirement accounts. And then by age 50, 6 times your salary. By age 60, 8 times your salary. And by 67, saving a full 10 times your salary would likely mean that you're ready to be completely financially independent and that you no longer have to work anymore.
Such an easy framework to use. I think probably everybody's pulling out their paper and pencil and doing some of the math themselves, and I hope that you are. One thing that you and I had talked about as we were preparing for tonight is just actionable insights and ways for people to think about getting themselves towards their goals, or helping them think through how to live a life that feels more personally wealthy. Can you speak to that a little bit?
Yeah, absolutely. I'm going to share another slide here. So this is a concept that I want to share with you. It's called a net worth conversion ratio. And the idea behind a net worth conversion ratio is it's how much of the money that you earn actually ends up sticking around to become part of your net worth. So net worth is everything you own minus everything you owe. So all of your accounts, savings, checking, investments, et cetera, retirement, all the things, your house, your car, those are all your assets. And then your liabilities are any loans that you have. So credit cards, auto loans, mortgages, etc., student loans. And for every dollar that you go up in assets or down in liabilities that you pay off a debt, your net worth goes up. So the idea is this net worth conversion ratio is a way to think about how much of my income is actually converting into net worth over time. So if you're spending every dollar that comes in, then your net worth conversion ratio is probably really, really small. So this is an idea to bring those two thoughts together of your net worth divided by your gross earnings is your all-time net worth conversion ratio. So if you're curious, you could look up your Social Security statement, which the Social Security Administration creates every year. Your earnings are actually on page 3 of your Social Security statement. Your Social Security statement is only 4 pages, so it's not overwhelming. But on the 3rd page, you have all of your earnings history as long as you've done work that pays into Social Security. So I will give that caveat. So if you added up all of that money that you've earned over your lifetime, and you put that on the bottom of the equation, and on the top, you put your net worth. That will give you a sense of how much of my earnings are actually converting to net worth over time and how much is just being spent. So that's the idea here.
So is there a goal or like a framework to think about the percentages?
Good question. I would say that the rate of change is the most important thing here. So I wouldn't worry so much about the absolute number of mine is 1% or minus 10% or minus 50%. I would say, is it going up over time? Is it trending in the right direction? Just like net worth, it doesn't really matter necessarily that your net worth is 20,000 or 200,000. What matters is that it's trending in the right direction, because that's a reflection that you're investing, that you're paying off debt, and that you're saving over time. So you're making good overall decisions with your money. Net worth is a nice way to see that at a high level, trending over time.
And I would imagine, because your client's income is so variable, which you spoke about earlier, that this is a equation that you suggest that people do frequently, not too frequently, but with some regularity over the long term, so they get a sense for what that trajectory looks like, recognizing that probably all of our financial pictures change a lot year to year, depending on circumstances. And this is something that we should look at over the long term. Is that true?
Exactly. Exactly. So just like net worth itself, I would say measure it annually. Any more often, you're probably going to get noise that might even be confusing or counterintuitive to what you're trying to accomplish. So I would say measuring it annually is helpful. You can do an annual net worth conversion ratio as well and say, how much did I earn last year? And then how much did my net worth change, to get a sense of how much of your income sort of converted into net worth. And with net worth and net worth conversion ratio, I would encourage you to just keep in mind that these are outcome focused measurements, which means they are influenced by some of the things that you have control over, some things that you only have influence over, and some things you have no control over at all, like the stock market. And so keep in mind that although it's important to check in maybe annually on these outcome focused calculations, where you're really going to have success is focusing on the activities that drive the right direction of this. Of numbers like your net worth or your net worth conversion ratio. And that's how much am I saving? How much am I investing? Am I spending less than I earn? All of those like solid habits. Am I increasing the amount that I'm saving over time incrementally? That's really where the focus should be on a regular basis.
So helpful. So how does this show up in practice for you and for your clients? Like, we know there's good debt and bad debt. Can you talk more about this? What should people think about when they're really grappling with the things that they can control?
Yeah, great question. So I'm going to share a couple more slides and then no more slides. But these are just a couple quick ones. This is something that I go over with my clients, and I've worked with clients over the 20 years that I've been a financial planner that run the gamut from just starting out in their careers, making maybe $30,000 a year or $25,000 a year, all the way up to clients who make $3 million a year. And I will say that this framework holds true regardless, which is you have to focus on your foundation first, creating stability in your finances. That gives you that solid foundation. Then once you have a solid foundation and you're stable, then you can start to work towards growth type goals and then ultimately towards independence goals, where I see people have big issues, even those that have multi-million-dollar net worths, is when they haven't built that solid stability sort of layer underneath. There's holes in their foundation. Then when things don't go according to plan, it can kind of all fall apart, if you will. But if they build their stability layer first and then growth and then independence, they are much more likely to be able to weather whatever comes their way, whether expected or unexpected. So the few things, here's a couple of ideas of things that fall into each of those layers. Stability are your financial foundation, paying your bills consistently, working on your credit score, paying off all high interest debt. And high interest, I would say, that's kind of the bad debt. I would say anything above 7% or so, I would put in that category. Non-mortgage, I guess, oh gosh, now some mortgages are above 7%, but non-mortgage debt above 7%, I would kind of put in that bad debt category. Building an emergency fund of 3 to 6 months of income or expenses is really critical so that you have money if things don't go according to plan. And then starting to invest towards retirement. Those are stability sort of things. Also having things like health insurance. And then growth. Maybe that's saving to buy a home, investing more fully for retirement, maybe saving for college, and maybe eliminating some of that good debt, but debt nonetheless. Those would be more like growth things. And then you move to independence, which are things like building wealth all the way to be financially independent, sort of that 10 times salary number, investing in rental real estate, providing a legacy, thinking about inheritance for other people. Those are all great goals, but I would say focus on the stability ones first, then the growth ones, and then start thinking about the independence levels.
Okay, I want to give a slight PSA, which down at the bottom of the screen, there's a Q&A little button, and we're almost going to open it up for Q&A from all of you. So if you want to start putting in your questions now, that would be a great time to do that. All right, just a couple more questions from me, Natalie. Where are your clients focused when they think about their finances?
Yeah, so my clients are focused. I would say one of the biggest things is creating a gap between earnings and expenses. There's a couple reasons for that. One is because if you're spending less than you earn, then that gives you dollars to try to build your net worth and make progress towards your goals over time. The other reason is because for my clients, their income is insecure and unstable. So they don't really know, am I going to make $500,000 or $300,000 this year, or am I going to make $1 million this year? For those on the private company side, those numbers can be anywhere from 200,000 to 5 million in a year. There's just so much variability. So keeping their expenses lower and allowing there to be a gap between their expenses and their earnings is really critical. I would say we're also really focused on putting money to work. So any money that's in savings is earning interest. Any money that is saved for retirement is invested in the stock market or real estate. And money will grow if you give it time to grow. You might have heard the rule of 72, but a dollar invested at 7% doubles every 10 years. So a dollar becomes $2 after 10 years. 10 years later, it becomes $4. And 10 years later, it becomes $8 and then 16. So money can really grow if you give it the opportunity to do it. So we're really focused on helping the money get to work as well, not just the client in their work life. And then the last one I think I'll mention is taking advantage of moments for linear progress and non-linear progress. So what I mean there is sometimes clients truck along, they don't have big windfalls, they don't have bonuses or equity compensation, they have their salary. And so in the years when they just have their salary, what we're really focused on is making incremental progress. Can you save 1% more this year than you did last year? And 1% the next year, and 1% the next year. So we're focused on making linear incremental progress during those years. And then when there are opportunities for bigger windfalls, whether it's from a bonus or maybe a big tax refund or an equity compensation, like if their company becomes worth a lot and they get to sell their stock, really taking advantage of those opportunities to make progress on their financial goals, which ends up building their net worth. I typically recommend that after the tax bill is paid, right? Like if you get a bonus of $5,000 and you have to pay $1,500 of it in tax, then you've got $3,500 left. With that $3,500, I often would tell my clients, take 10% of it and do something fun, blow it. I don't care what you do with it. And then the other 90%, let's put it towards your goals. And we'll focus on stability goals first. If those are all checked off, then we'll look at growth goals. So that's kind of how we approach it. But I would say those are a few places that my clients are really focused.
Thank you. There's so many good questions coming in. I want to be sure that we give time to them. So I'm going to move to
Awesome.
that. Related to what your point that you were just making, there's a question here. Thoughts on living below our means for future financial growth? Will that cause you to stress? So it's something you were kind of talking about before, just trying to widen the gap between what you spend versus what you make. And can you talk a little bit about that in more detail?
Yeah, I think the first step in creating that gap at all is to make sure that you're just tracking your budget. I don't think that budgeting has to be penny for penny. I don't think you need to nickel and dime yourself. But having a sense of how much is coming in, a clear sense of how much is coming in and how much is going out is like step one, just having that clarity. And then create the gap and do it incrementally. So if right now you're spending about what you're earning, that's fine. Can you make a gap of $50 a month or $10 a week, however you budget? And then figure out, okay, well, if it's 10, can I make it 15? Can I make it 20? Are there any ongoing expenses like subscriptions, for example, that I can let go so that I can kind of get 12 months worth of gap, right? I would say that it's important that you have a budget that supports a life that you enjoy. So I'm certainly not telling you to like go cut out everything that brings you joy in life, but I do think it's important to start to incrementally work on that gap if you can.
That's great advice. So 2 questions that I'm going to combine together. You might be getting to this later, but I'm in my 50s. How do I recover the lost time? And one person, I'm freaking out because I'm 49. I'm way behind. Is it too late? And I'm sure you're going to offer some encouraging words, but let's hear it now.
Yes, it's definitely not too late. I remember I worked with a client who came to me because he was 82 and she was 78. And they lived a very luxurious life. And when they came to work with us, the wife realized that the husband's retirement plan was that he was just going to work forever, and they actually had nothing saved. So that is a little close to too late, right? But 49, 50, not too late at all. I would say that one of the biggest fallacies is like, I can't do enough, so I'm not going to do anything at all. That's one of the things that will get you into trouble, whether you're 30 or 40 or 50 or 60. Every little bit makes a difference. It really, really does. So I would say figure out what you can start with and then make a goal for yourself to increase that amount over time. So if you can save 3% of your income into your 401k plan at work, fantastic. In 6 months, put a note in your calendar to bump that up by 1%. Your paycheck will go down a little bit, but you probably won't notice it that much. And I bet you can hang with it. Every 6 months, increase it, and you'll be at 10+% before you know it.
That's really good advice. There's so many questions coming in about your calculator. So I want to be sure that maybe we can talk about that one more time. So there's
Oh,
a
sure.
question here about how is net worth calculated? If there's, I'm just going to pull up some of the other ones. Maybe you want to pull up the slide one more time, Natalie, because people had so
Sure.
many good questions about it.
Yeah.
When it comes to age versus savings, what if your salary changes between 30, 40, and 50? If salary is only part of your overall income, how do you adjust your retirement multiple? So maybe we just want to cover off on that a little bit more. And then
Yes.
did I ask this question already? But like, how is net worth change calculated? So maybe you could just recap this a little bit.
Yes, definitely. So I'm going to answer the second 2 questions, and then I'll go back to the net worth one. So what if salary changes? So I gave that kind of like 1-time salary at 30, 3 times at 40. I don't have it in front of me at this moment here. Let me just re-say the numbers because I think they're helpful. 1 time at 30, 3 times your salary by 40, 6 times by 50, 8 times by 60, and 10 times your salary by 67. So if you're working on that framework, it's not a guarantee, but it's like a pretty close, like it's a really great rule of thumb that is true in a lot of cases. If you're working on that, how do you do it when your salary changes? It's generally based on your current salary at the time. So what you would expect is that your salary would grow over time, right? inflation is 3% a year. Generally, wages go up about 3% a year as well. And then if you're growing in your career from age 25 to 35, you may take a bump in your income because of a promotion, for example. So the idea is that this is of the amount that you're making at that age. So when you're 30, if you're making $50,000 a year, then your goal would be $50,000. If by 40, you're making $75,000 a year, then your goal would be 3 times $75,000. So the reason that it goes up that way is because that's a way that the calculation is able to keep up with your lifestyle inflation. Because generally, as we make more, we tend to have about the same savings rate over time. Even though we can say, oh man, if I made twice as much, I would save all the rest or most of the rest. That typically doesn't come to fruition. Our lifestyle typically uses up most of our income, the same proportion of our income. So as you're working with those numbers, it's the amount that you're making at that age as well. So I think we've covered that one. And then in terms of net worth conversion ratio, I would say the most important one, if you're interested in the all-time one of like, how much money have I made in my whole career? And then how does that compare to my net worth? Great. Go look at your Social Security statement, add up all the numbers. It's a really interesting number to see. But I think the more important one is the second one, which is what's the rate of change in a given year? So we're going to look at this second example here. I know these numbers are really big. I took these from a client. So that's why I used these numbers, is because they're directly from a client that I calculated this for. So we're going to look at this second example here that says example annual 49%. So for this client in the last 12 months, so in 2023, their net worth change, so their net worth went up by $225,678. So if it was $1 million at the beginning of the year, by the end of the year, it was $1,225,678. So that's the amount their net worth went up last year. The amount that they earned last year was $463,963. This happens to be a dual income tech couple, and that's what they made last year. So about half of the amount that they earned actually went into their net worth. Now, it's not because they were saving half, it's because the market grew, so that the money that they had already invested previously grew, and that's largely where that net worth growth came from. They also added about $50,000 to their investment accounts, but most of the growth in their net worth came from the fact that they've been investing aggressively over time, and the market did well in 2023. And so their net worth sort of got credit, if you will, for that growth. So that's why I say, like, sometimes this number can be tracked really closely to the activities, to the actions that you took. And sometimes it's based on what the market did in a positive direction or a negative direction. So it's an interesting number to look at. The trend over time is more important than the absolute number at any given moment, because there's so many numbers that influence these numbers.
Thank you, Natalie. I'm going to change gears a little bit. Wency is asking, I work as a project manager who works on contract. I can sometimes go 6 months between contracts, so I get in the habit of paying as many bills ahead of time before the contract ends and then tightening my belt when there's no work. I have no emergency funds. Should I focus less on paying bills early or more on emergency funds and savings? And then conversely, I have Maurice here, who's newly retired from teaching part-time and works sporadically in acting. He's wondering, my question is, should I invest more in my business versus my investments accounts? And I'm pairing these two questions together because it's people that are just asking about how to balance where to put their money at certain times in their life and with variable income. And so maybe you can speak overall about your approach to thinking about something like that.
Yeah, absolutely. So tangibly in each case. So for the first one, the project manager who works and sometimes has gaps in between, I would say cash is the most flexible thing that you can have. So if it's a choice between should I prepay bills or should I build up an emergency fund, the emergency fund is going to give you even more flexibility than paying your bills in advance. And so I would say it behooves you to save up the cash and put it in a savings account that's earning some interest. so that you have the flexibility to use those dollars to pay your bills if needed. But I think psychologically, it will give you more comfort to actually have that cash in an account than to have your bills prepaid. And then for this second person, should you invest more in your business or invest in accounts? That's a hard one to answer because I don't know a lot about your business and what it looks like to invest it and what the outcomes might be there. So that's a really hard one to answer. I would say overall, if we look at sort of that stability, growth, independence sort of framework, from a stability perspective, I would just make sure that your foundation is built solid. And that stability, growth, independence framework is not necessarily do these things in your 20s and 30s and these things in your 40s and then these things in your 50s plus. You can be at any level at any age. And you can also kind of jump levels, right? So you might rush through one level to another, but then in another season of life kind of fall back a step and need to focus on a different level. So I would say even if you've just retired from part-time teaching and you're teaching sporadically, I would make sure that your foundation, your stability sort of things are all checked off before you invest money anywhere. If all of those are checked off, then you could look at investing. And I hate to say it, but I can't answer whether it should go into your business or your investment accounts.
Great answer and very PC. All right, so we're entering tax season, and someone had a question here about mitigating taxes. So some strategies for doing that are pretty obvious, taking advantage of 401ks, HSA, etc. Are there other strategies that fewer people are aware of?
That's a really good question. 401ks, HSAs, an interesting one because the standard deduction is so big now, especially for those who are married, it's almost $30,000. Most Americans are not getting a tax benefit on their mortgage interest. So this doesn't directly answer the question because it's not a way to save tax. It's just sort of a disclaimer that most people who think, oh yeah, but my mortgage interest is tax-free, so I don't worry about it. For most of us, it actually doesn't help us on our taxes at all because we already get a standard deduction that's bigger than our mortgage interest and all the other things that you add up. And so mortgage interest actually doesn't help most Americans on their taxes. In terms of other ways, there's a lot of situational ones. If you have kids, there's some tax credits available. If you own a business, there are opportunities for tax deductions. If you own rental real estate, depreciating your real estate can be a substantial tax deduction and help you to have rental income that's pretty much tax-free. So that can be a helpful one if you happen to own rental real estate.
Thank you. All right, we're getting towards the end, so maybe this might be the last question. Can you speak to the best strategies of managing credit card debt and investing?
Yes. You are rarely going to earn as much in investing as you pay in credit card debt. You've probably heard that before, right? If you're paying more interest than you're earning in growth, then it makes more sense to pay off credit cards. That is generally true. I will say if you're getting a 401k match, then the math can be more in your favor, right? Well, if I put in 3% and my employer puts in 3%, I'm actually getting 100% return on the 3%. That's true. So I would say if you've got credit card debt that you carry from month to month that you're paying interest on, it is more of a priority in most cases than investing. The caveat is if your employer is offering a match, even a 50% match, right? If you put in 3%, they'll put in 1.5 kind of thing. You put in $1, they'll put in 50 cents. That is a better deal than the credit card interest that you're paying. In terms of the strategy on paying off the credit card debt, pay off one card at a time, the highest interest card first in most cases, unless you've got a 0% one that's going to blow up at some point soon, then you might want to throw that one first. But in general, you want to focus on paying the minimums on all of your credit cards except the highest interest rate card so that you can get the most bang for your buck, if you will, with every dollar that you're paying off in credit card debt.
Great, thank you. I forgot there's one question that I wanted to absolutely ask, which is from the survey that I mentioned earlier, we know that financial literacy is improving, but 20% of people think the bulk of their savings should be all cash. What do you say to people who might feel this way?
It's a great question. I would say that it's really important to have the right amount of cash. It's important to have enough cash. Most people don't have enough cash. So if you're going to err, probably more cash is the way to err compared to what you have now. So I would say that first and foremost. But when we talk about investing for a retirement goal, for example, it's really critical that you invest and not just put money in savings for longer term goals. So anything that's 5 years or more out, investing can really help you make progress on it. The reason is because if the money is going to grow itself, it's going to compound and double every 10 years. That's less money out of your pocket that you have to put into that account to reach that 3 times of salary at 40 or 6 times salary at 50, et cetera. So if you can let your money grow, if you give your money the opportunity to grow, then you have to take less money out of your pocket to be able to be on track for a longer term goal. So 3 to 6 months in most cases of emergency fund, 3 to 6 months of income or expenses, depending. Usually those numbers are very similar. And then the rest, if it's for longer term goals, I would encourage you to invest.
All right. Well, thank you. With that, I'm going to pull up our end screen here. It's my job to close us out. I want to thank all of you who spent the past 40 minutes with us, learned from Stash experts so you can, oh, I was not on screen. Hi again, it's me. Learn from Stash experts so you can make the most out of Stash. As a reminder, this information that we shared today is purely educational. We're not providing any financial, legal, tax, or investment advice. Thank you everyone for coming. Look out for an invite for the next webinar coming up in a few weeks from us at Stash with some really exciting panelists. Too soon to share the details, but again, thank you so much for coming. I hope you all have a wonderful, wonderful evening and week and weekend ahead. Thank you, Natalie, for joining us today, and we hope to see you soon. Thank you.